Welcome to the Pro Ticker Deep Dive.
It is good to be back.
Today is Wednesday, February 4th, 2026. And I have to be honest with you, I woke up this morning, I pulled up the terminal to check the pre-market action, and I genuinely thought my data feed was glitching.
You were not the only one. I think half of Wall Street was hitting the refresh button on their browsers at 6 a.m.
The atmosphere is just absolutely electric. We are right in the thick of earnings season. And, usually this is a routine, right?
Mm-hmm. Predicted.
You get your banks, you get your big tech, you check the EPS beat, you listen to the guidance, maybe yawn a little bit, and you move on. But there is one story today that is just sucking all the oxygen out of the room.
It really is. It is the only story that matters right now.
We are talking about Palantir Technologies. And usually when we talk about quarterly earnings, it is dry, it is spreadsheets, it is, did they beat by a penny?
Right.
But this feels different.
Yeah.
We're looking at a company that seems to be defying the laws of physics in the stock market right now.
That is not an exaggeration. If you actually look at the mechanics of what just happened, it shouldn't really be possible for a company of this size.
I mean, imagine a company that is capitalized at over $350 billion. So this is not a small cap. This is a titan.
A giant.
Growing its revenue at a pace that usually belongs to a tiny startup, but is doing it at a massive scale and simultaneously printing cash with margins that make other software giants look, frankly, inefficient.
It's a rare combination. It's what investors spend their whole careers looking for and almost never find. And I think what we are seeing today with these Q4 2025 results isn't just about good numbers. It is a signal. It's a regime change.
Regime change, that's a big phrase.
I mean it. For the last 3 years, ever since ChatGPT dropped, we have heard about the AI supercycle. It was a buzzword. It was marketing fluff.
Right. Every CEO just dropped AI into their earnings call.
Exactly, just to bump the stock price. But looking at Palantir's performance today, we are finally seeing that cycle move from hype to operational reality.
So Palantir has effectively graduated.
In a way, yes. They have transitioned from being that secretive government contractor, the spy tech company that nobody really understood, to becoming what looks like the operating system for the modern enterprise. And the numbers, well, the numbers back that up completely.
Okay, so that is our mission for this deep dive. We are going to unpack these absolutely wild Q4 2025 results. We need to explain this explosion in U.S. commercial adoption, which is just off the charts.
It's just incredible.
And we need to talk about something called ShipOS, which sounds like science fiction, but is apparently fixing submarines.
And of course, we have to have the hard conversation about the valuation, because depending on who you ask on Wall Street today, this stock is either the biggest bubble since the dot-com era, or it is still undervalued.
Exactly. It's polarizing. But before we get to the debate, we have to look at the scoreboard. Let's talk about these bombastic numbers. And I'm using that word because that is literally the word CEO Alex Karp used to describe them.
It fits. Karp has never been one for understatement, but in this case, bombastic might actually be accurate.
Let's start with the headline. Q4 2025 revenue came in at 1 billion dollars. That is a 70% jump year over year. Now, usually when companies get this big, growth is supposed to slow down. That's the law of large numbers.
Right. You expect gravity to kick in. When you are doing $100 million in revenue, doubling is, relatively easy. When you are doing $1 billion a quarter, growing by 70% is mathematically incredibly difficult.
But Palantir is accelerating. They aren't slowing down. They are speeding up. How is that possible?
It is accelerating because they have cracked the code on the commercial side. If you look under the hood of that $1.41 billion, the engine driving this is U.S. commercial revenue. That specific segment surged 137% year over year to $507 million.
Hold on. 137% growth in the commercial sector.
Correct. More than doubling in a single year.
That is just staggering.
Yeah.
For years, the bear case on Palantir was, oh, they're just a government consultant. They're at a services shop.
Right.
They can't scale in the private sector because their software is too clunky, too expensive, too weird.
Exactly. That was the narrative. Palantir is for the CIA, not for Costco. This quarter effectively kills that argument. It buries it. The product has gone viral in the private sector.
Viral is a strong word for enterprise software. Usually viral means a funny video on TikTok or a meme stock. It doesn't mean a data integration platform.
In this context, viral means the adoption is happening faster than their sales team can even keep up with. which we will get to when we talk about their boot camps. It's demand-driven growth, which is very different from sales-driven growth.
Oh.
But there's another metric here that actually made my jaw drop. I had to double-check the math. We need to talk about the Rule of 40.
Okay. Let's unpack this for the listener because this is a really important concept in SaaS software as a service. The Rule of 40 is a standard benchmark, right?
Exactly. It's a health check. It's the gold standard for software investors. You take your revenue growth percentage and you add it to your profit margin. If the sum is over 40%, you are considered an elite, healthy software company.
Right. So if you were growing 20% and have a 20% margin, you hit 40. You get a gold star.
Precisely. Most companies struggle to hit 40. You might have high growth, say 50% growth, but you're burning money, so your margin is negative 20%.
Which puts you at 30.
Right. Or you have high profits, but low growth.
It's a trade-off. So Salesforce, Adobe, the big legacy players,
Yeah.
they're usually in that 30 to 50% range on a good day.
Correct. And they fight tooth and nail to stay there. Now, Palantir posted a Rule of 40 score of 127%.
127%. That sounds broken. Like, did they break the math?
They broke the framework. When you break that down, you have roughly 70% revenue growth plus a 57% adjusted operating margin. That is historically rare. I struggle to find a comparable enterprise software company at this scale putting up those numbers.
I want to pause on that 57% margin.
Yeah.
Because 70% growth usually means you are spending money like a drunken sailor to acquire customers. You're hiring thousands of salespeople, you're buying Super Bowl ads, you're flying clients to Hawaii.
Right, you're burning cash to grow.
How do you grow 70% and still keep 57 cents of every dollar as operating profit?
That is the magic trick, and the answer is operating leverage. It means they don't need to spend linearly to earn linearly. They can add massive amounts of revenue without having to hire thousands of new salespeople or engineers to support it. The software is doing the work.
This goes back to the old critique that Palantir was just a services company in disguise. The argument was that for every contract they won, they had to send 50 engineers to the client's site to customize the code. If that were true, their margins would be terrible.
Exactly. Services businesses have low margins, maybe 15, 20%, because human labor is expensive and it doesn't scale. You can't clone your engineers. A 57% margin proves mathematically that this is a software product, they deploy it, and it scales without linear human intervention.
And that leads to the cash flow. Because for a long time, another bear argument was Palantir burns cash.
Not anymore. Adjusted free cash flow for the quarter was $791 million. That is a 56% margin. They are keeping more than half of every dollar they bring in as free cash.
And they're just sitting on it.
They're building a fortress. They have $7.2 billion in cash and treasuries on the balance sheet.
Right.
And zero debt. This kills the unprofitable tech startup narrative dead. They are a cash-generating machine now.
$7.2 billion. That's a war chest. They could buy a lot of small companies with that. But Karp says they don't acquire.
Right. They hold it. In a high interest rate environment, that cash is earning the money. It's also a signal of stability to their biggest clients. If you are the U.S. government, or if you are BP or Airbus, you want to know your software provider isn't going to go bankrupt next year.
That's a good point.
A $7 billion pile of cash says we aren't going anywhere.
It really is a complete flip of the script from where they were just a few years ago. But the big question, and this is where I want to get into the weeds, is how? How do you grow commercial revenue 137% in a year? Is it just that AI is hot? Or are they doing something fundamentally different in how they sell?
It's both. But the execution is what matters. This brings us to the core of their strategy, the boot camp model.
We hear this term boot camp thrown around a lot. But let's contrast it. Traditionally, if I want to sell enterprise software to a big company, let's say I'm selling to a massive manufacturer like Tyson Foods or General Mills, how does that usually go?
Oh, it is painful. It is the steak dinner model. I'm a salesperson. I call the CIO. I take them to a fancy dinner. I show them a PowerPoint deck with stock photos of people shaking hands. We talk about synergy.
A lot of synergy.
A lot of synergy. Then, maybe 3 months later, we sign a pilot agreement.
And the pilot takes 6 months.
Minimum. And usually the pilot is on dummy data. It's a sandbox. Then after 6 months, maybe we sign a contract. The whole sales cycle can take 12 to 18 months. It is agonizingly slow and incredibly expensive.
Palantir looked at that and said, this doesn't work for AI.
Right. Because AI moves too fast. By the time you finish an 18-month sales cycle, the technology has changed 3 times. So they pivoted to these boot camps.
Describe a boot camp for me. What actually happens?
Instead of a slide deck, they say, give us 5 days. We will come in and we will build actual workflows on your actual data.
5 days.
Sometimes less. We are seeing reports of Palantir units of time being measured in hours. They get the customer's engineers and the Palantir team in a room. Pizza, energy drinks, keyboards clacking.
I can picture it.
And by the end of the week, they aren't looking at a demo or a mock-up. They are looking at a production-ready application running on their live data.
So they moved from pilot purgatory to production value almost instantly.
Exactly. It's show, don't tell. When a CEO sees their own supply chain problems being solved in real time on a screen after 3 days, the check writes itself. You don't need a salesperson to convince them. The value is self-evident.
But wait, how can they do that? I mean, integration is hard. Data is messy. Usually spending 6 months cleaning data is just the reality of IT. How can Palantir walk in and do it in 48 hours?
That is the billion-dollar question, and the answer lies in the technology itself, AIP, their artificial intelligence platform, and specifically something called the ontology.
Okay, ontology, that's a $10 word. I feel like we hear this word and people nod like they understand it, but I want to really break it down. To the average IT director, how is an ontology different from the SQL database they've been running for 20 years?
That is the critical distinction. The best way to think about it is the difference between a spreadsheet and a map.
Walk me through that.
Okay. Most enterprises run on relational databases, rows and columns. You have a table for customers, a table for orders, a table for inventory, but the database is dumb.
Right.
It doesn't know what a customer is. It just knows row 4, column B contains the string Acme Corp.
It's just text and numbers and cells.
Right. If you want to know if Acme Corp can receive a shipment, the database doesn't know. A human has to write a complex query to join 5 different tables, checking the customer table, the warehouse table, the inventory table to find out. You are translating business logic into SQL queries every single time you want an answer.
And that translation layer is where the friction is. That's why it takes months to build anything.
Exactly. Now, Palantir's ontology is different. It's built on objects, similar to object-oriented programming. In the ontology, Acme Core isn't just text. It is an object defined as a client. And that object has properties attached to it: location, credit limit, loading dock capacity, and crucially, it has actions it can take.
So the software understands that a truck object cannot deliver to a warehouse object if the warehouse is marked closed.
Precisely. The logic is baked into the data layer. It's a digital twin of the organization. So when the AI looks at the data, it understands the physics of the business, not just the text.
This is why AIP is different from just plugging ChatGPT into your database.
Yes. If you ask a standard LLM, how do we increase production? It might hallucinate a generic answer like, hire more people.
Right.
But if you ask AIP, it hits the ontology. It sees the factory object. It sees the machine objects inside it. It knows machine A is down for maintenance because that status is bound to the object. So it says, you can't increase production unless you fix machine A.
It effectively creates a digital constraint system that mirrors the physical world. It grounds the AI in reality.
Correct. It moves AI from creative writing, which is what chatbots do, to operational planning. And that is the moat. Google has the LLM, Microsoft has the LLM, but Palantir has the ontology that gives the LLM the context to actually run a factory.
And now with these boot camps, they are giving these tools directly to the customers to build with.
That's the builder revolution. They launched something called the AI FDE, the Forward Deployed Engineer. But here's the twist. Traditionally, a forward-deployed engineer was a human Palantir employee sent to your site.
Right, the smart person in the t-shirt who fixes your problems and sleeps under the desk.
Now, the AI FDE is an agentic capability. It's an AI agent that acts as an engineer. It can write code, connect data sources, and build pipelines autonomously.
Wait, so the software is building the software?
Essentially. They also release Workflow Builder and HiveMind, which are tools allowing non-technical users to visualize these complex automations. This lowers the barrier to entry significantly.
So you don't need a PhD in computer science?
Not anymore. You don't need a PhD to deploy Palantir. The software helps build itself.
That explains the margin expansion we talked about earlier. If the software builds itself, you don't need to pay a human engineer $200,000 a year to do it.
Exactly. That is the operating leverage. The AI agent costs pennies of compute power to do what a human consultant used to do in a week.
Okay, so that's the commercial side. It's fascinating. But we can't talk about Palantir without talking about their roots, government and defense. And looking at these Q4 materials, they are doing some mind-bending stuff with the U.S. Navy.
This is what we call Section 3 in the outline, but really, this is the heart of the company. This is rebuilding the arsenal, and frankly, this is where the real-world impact is most visible.
Let's talk about ShipOS.
ShipOS, it's exactly what it sounds like. An operating system for ships, specifically focused on the maritime industrial base building and maintaining submarines.
And for the listener who doesn't follow defense procurement, we need to context this. Submarine production is arguably the single biggest bottleneck in the U.S. military right now.
It is a crisis. The Columbia-class and Virginia-class submarines are behind schedule. You have massive supply chain delays, labor shortages, all the welders are retiring, and the complexity of these vessels is insane.
I can't even imagine.
A submarine is basically a city inside a pressure hull that has to go underwater for months. It has millions of parts.
It's not like building a Ford F-150.
No. And the coordination problem is massive. Palantir deployed Foundry and AIP to partners like General Dynamics Electric Boat and the Portsmouth Naval Shipyard to solve this coordination problem. And the results cited in their investor presentation are they are hard to believe until you see them.
Give us the numbers.
They cite a specific process called material review. So you're building a sub and you find a part that is slightly out of spec. Or maybe the paperwork is missing. You have to stop work. You have to review it. That process used to take weeks.
Weeks of the submarine sitting in dry dock doing nothing, costing millions.
Right. With ShipOS, that review process is down to under 1 hour.
From weeks to an hour.
Yeah.
That's not an efficiency game. That is a transformation.
It completely changes the tempo. And look at schedule planning, figuring out who does what and when. Okay, the welders need to go in here, but the electricians aren't done yet. That planning used to take 160 hours of human labor to figure out the schedule for the week.
Okay.
It's now done in 10 minutes.
160 hours to 10 minutes. That is, the analogy that comes to mind is fixing a car engine. Imagine you're trying to fix your car, but instead of spending 3 days looking for the manual and ordering parts and waiting on hold,
Right.
the manual reads itself to you,
Yeah.
tells you exactly what to do, and the parts order themselves instantly.
That's a great analogy. It compresses time. And in a military context, time is the most valuable asset. If you can get a submarine out of dry dock 3 months earlier, that is a strategic advantage for the United States Navy.
They're calling this initiative warp speed. Right?
Yeah. Yes. And it applies to manufacturing, too. They cited data from a weapon system manufacturer where root cause analysis coverage, figuring out why a part failed, went from less than 20% to over 99% in less than a week.
So previously, they only knew why things broke 20% of the time.
Basically. The other 80%, they just scrapped the part or guessed. Now they know 99% of the root causes. That means they can fix the production line and stop making bad parts. This isn't just about efficiency, it's about the reindustrialization of the Western defense space.
It feels like Palantir is positioning itself as the fix for the hollowed-out industrial base we keep hearing about.
They absolutely are, and they are doubling down on the human element, too. I saw something about the American Tech Fellowship.
Yes, the ATFV. This is a smart cultural play. It's a program to train active duty service members and veterans to be builders on AIP.
So taking the people who know the mission, the people who have actually been on the submarines or in the field, and giving them the best software tools?
It makes sense. Who knows how to fix a logistics bottleneck better than the sergeant who had to wait 3 weeks for a spare tire in the desert?
Exactly, and it aligns Palantir explicitly with the military and Western values. And we should note, this contrasts sharply with some other Silicon Valley giants. Historically, companies like Google or Apple have been hesitant to work too closely with the Pentagon. Their employees protest. Palantir leans into it. They are proud of it.
They're waving the flag. Which brings us to another area where they are expanding, which is arguably just as critical as defense: infrastructure. Because they aren't just running the military. They are trying to run the grid that powers the country. They've launched something called chain reaction.
This connects the dots between AI and the physical world. We all know AI requires massive amounts of data centers.
And data centers require massive amounts of electricity. I read somewhere that a single AI query uses 10 times the electricity of a Google search.
It's huge. And the U.S. power grid is aging. It's fragile. We can't just plug in 1,000 new data centers and expect the lights to stay on. Chain reaction is Palantir pitching itself as the operating system for energy. They are working with founding partners like CenterPoint Energy and NVIDIA.
NVIDIA's involved? That's interesting.
Yes, the logo is right there on the slide. Think of it this way. NVIDIA builds the engine, the GPU, but you need a transmission to get that power to the wheels without blowing up the car. Palantir wants to be the transmission.
Managing the load balancing.
Managing grid reliability, accelerating power plant construction, optimizing data center operations. If you are building a new power plant, the regulatory hurdles, the construction schedule, the supply chain is just as complex as building a submarine. Palantir says, use our software to build the power plant faster so you can plug in the NVIDIA chip sooner.
It seems like they are expanding everywhere. I saw Hyundai as a massive partner now, too.
The Hyundai partnership is huge. This is the largest partnership they have in Korea. It's group-wide. They are using Palantir for shipbuilding, refineries, robotics. It's a massive endorsement.
And Accenture, because that seems different. That's a consulting firm.
This is the scale lever. Accenture is training over 2,000 professionals on Palantir. This is significant because it addresses that people bottleneck we talked about.
Right.
It means Palantir doesn't have to do all the selling and implementing themselves. They have an army of consultants from Accenture doing it for them.
So Accenture sells the project, Accenture consultants do the work, and Palantir just collects the software license fee.
Exactly. That is pure margin. That is how you get to that Rule of 40 score of 127%.
Okay, so the business is firing on all cylinders. Government is solid, commercial is exploding, margins are up, they're fixing the grid. But, and there's always a but, we have to talk about the stock price, because as much as I love the story, looking at the valuation makes me sweat.
It's the elephant in the room, no question.
Depending on when you check your app, this stock is incredibly volatile. On earnings news, it swings 10, 15% in a day.
Yeah.
And the price tag, it is expensive.
It is nosebleed territory by traditional metrics.
Let's play devil's advocate.
Yeah.
What are the skeptics seeing? Because if I'm a value investor, if I read Warren Buffett, I look at this and I run away screaming.
You do. They are looking at the multiples. Palantir is trading at something like 50 times forward sales.
50 times sales.
Not earnings, sales. And nearly 90 times forward free cash flow. The PE ratio is over 300.
For context, what is a normal high-growth software company trading at?
Maybe 10 to 15 times sales, 20 if they're really hot. 50 is, well, it's stratospheric. It recalls the dot-com bubble. I remember Sun Microsystems in 1999 trading at 10 times sales, and Scott McNealy, the CEO, famously told investors they were crazy to pay that.
Right.
He said, do you realize how much money I have to make to justify that? Palantir is at 50 times.
So are investors walking into a buzzsaw here?
The bear argument is that this is priced for perfection. If growth slows even a tiny bit, if that 70% drops to 50% next quarter, the stock could get crushed. It's the vertigo risk. Don't look down.
But then you have the bulls, and they're just as passionate. Analysts like Dan Ives at Wedbush are calling this the Messi of AI.
I saw that.
Citi raised their price target to $260. They seem convinced.
The bull case relies on the idea of a super cycle or a paradigm shift. They argue that traditional metrics break down when you are dealing with a company that is capturing a new layer of the economy.
Like the internet in the late 90s, Amazon looked expensive for 20 years.
Right. If Palantir really is the operating system for the entire AI economy, if they become the Grid OS and the ShipOS and the Factory OS, then maybe 50 times sales is actually cheap in hindsight.
You're saying they are pricing it like a utility monopoly rather than a software vendor?
Exactly. If they capture the infrastructure layer, the margins we talked about, that 57%, might actually expand. So while a 300 PE looks insane today, the argument is that the earnings is about to explode upwards, bringing the ratio down to earth faster than the chart suggests.
It's a bet on operating leverage kicking in at a global scale.
It is. But let's be clear to the listener. This is not a savings bond. This is a high conviction, high volatility play. It depends entirely on your timeline and your stomach. If you look at the 2026 guidance, they are guiding for 61% growth. The company is promising to double in size very, very quickly.
But if the market sneezes?
If the market sneezes or if the Fed gets hawkish, stocks with these multiples are the first ones taken out to the woodshed. You could see a 30% drawdown in a month and nothing fundamentally would be wrong with the company. That's just the nature of the stock.
So don't put your rent money in it.
Definitely not.
Let's wrap up with leadership and philosophy. Because you can't talk about Palantir without talking about Alex Karp. He was on the earnings call, And he was himself.
He was. He called the numbers bombastic and authentic.
I love that he calls them authentic. What does he mean by that?
He means they are organic. He takes a lot of pride in the fact that Palantir hasn't grown by buying other companies.
All right.
Most big tech companies, when growth slows, they go buy a competitor to juice the numbers. Palantir didn't acquire their revenue. They built better software.
He also made a really interesting comment about credentials.
Yes. He said that having Palantir on your resume is now the ultimate status symbol in tech. He basically said, I don't care if you went to Harvard or if you dropped out. If you are a Palantirian, that is the only credential that matters.
It's a bit cult-like, but effective.
It creates a thick, dense culture, as he puts it. And that culture acts as a moat. It is very hard for a competitor to replicate that level of intensity and mission alignment. You can copy code, but you can't easily copy a culture that believes it is saving Western civilization.
And that mission is explicitly aligned with the West.
Unapologetically. They support U.S. deterrence. They support Western allies. In a world where geopolitics is getting messier, Palantir is picking a side. And Karp believes that this cultural clarity is actually a business advantage. Clients know where Palantir stands.
So let's synthesize all of this. We have a company that has crossed the chasm. They aren't just a niche spy tool anymore. They are a commercial juggernaut.
They are capitalizing on the AI revolution not by building the models, which is becoming a commodity, but by building the factory that uses the models.
And that leads me to my final thought for the listener.
Awesome.
We've talked about submarines, we've talked about factories, we've talked about the power grid.
Right.
If Palantir is becoming the operating system for both the U.S. military and the U.S. commercial supply chain, does investing in Palantir effectively become an index fund on American industrial dominance?
That is the billion-dollar question. If you believe in the reindustrialization of America, Palantir is arguably the purest play on that thesis.
And if ShipOS works for submarines, how long until we see CityOS running our traffic lights or GridOS running our entire electrical infrastructure? Are we looking at the software layer for, well, everything?
It raises the question of how pervasive this ontology approach can get. If it works for the Navy, why wouldn't it work for the government? For healthcare? For your city? It's a provocative thought. We might be watching the birth of the first true industrial AI monopoly.
It certainly feels like history in the making. Well, that is all we have time for today. Thank you for joining us on this deep dive into Palantir's bombastic quarter.
Thanks for having me.
We will catch you on the next one. Stay curious.